Today was FOMC and the market got the green light to rally. Powell pivoted and the market rallied, small caps rallied, and even my mom is buying stocks. And the big number on everybody's mind is 37,000. That's where the Dow closed today, reaching new all-time highs as euphoria kicks in. And now it's time for the chase. Those that missed the rally are chasing, and the money on the sidelines is starting to make its way into the market, with the biggest stock in the world, Apple, also hitting new all-time highs. And what comes next may actually surprise you. But it wasn't all good news. We need to talk about PPI. It came in a lot cooler than expected, and that means the economy is also cooling. And we are seeing some seriously worrying signs of deflation. So join us today as we talk about stocks and the financial markets and answer the question, where to next? Hello, ladies and gentlemen. Welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. What a day in the market. Apple hitting new all-time highs. It was leading tech. Microsoft put in a flat day, but they were down nearly 0.5% at the start of Adobe, down 1.48%. We're going to talk about them a little later. And the best performing sector was utilities. Just crazy. All of these rate sensitive sectors put out amazing days. Real estate, really good. Metals, utilities, the best performing three sectors in the spiders. Look, GDX 6%, gold miners, regional banks as well. And it wasn't, the market was waiting for what Powell was going to say for the PPI data. And when we got it, one of two things was going to happen. It was either going to be a rally or a complete dump. We got the rally, and especially in smalls. Look at how strong small caps were. I mean, everything, value, growth, large cap, mid caps are all strong, but especially the small guys. And commodities too. Commodities rally. It wasn't everything rallied. Bonds rallied, commodities rallied, everything rallied. Look at gold, look at crude, look at natural gas. Everything was on an absolute tear. And the weekend poll, the next 100 points in the S&P 500, up or down, 56% of you said up, and you guys were correct. The next 100 points in the S&P 500 were up. Absolutely crazy price action. And if you guys want to take part in this week's poll, go ahead, subscribe below on YouTube, follow me on Twitter so you get the latest poll. And there were two big events today, PPI and FOMC. And PPI came in very cool, a lot cooler than expected. In fact, 0% month over month, they were expecting 0.1%, as well as 0.9% year over year. We were expecting a 1% consensus. And core came in super cool. So excluding food plus energy, 0% month over month, we were expecting this, and at 2% year over year, we were expecting this. And it's quite simple. Energy costs have been seeing significant decline. The price of crude is down like 6% in the last month, and we're seeing deflation in food prices, and this is why core came in pretty cool. Now that was PPI. We also had the FOMC decision and Powell speaking, and this was very bullish. Powell pivoted. It simply is what it is. Powell pivoted. The Fed is not driving the bus anymore. Inflation and employment are driving the Fed, and they're seeing inflation moderate, and they have to pivot. Powell has to pivot. What really changed, in my personal opinion, I think, was when he said, we discussed the timing of rate cuts, very bullish, and also said in determining the extent of any additional policy firming. Long story short, that is the pivot. Moved closer to the market, they kept the fund rate unchanged, and they recognized that inflation is falling, and especially in shelter, there's lags in shelter. They recognize this. It was a dovish move, it was a dovish statement, it was a dovish presser. And we also got the dot plot. This is 2024 right here, and you can see definitely getting the Fed fund rates under the 5%. The majority of the FOMC participants said that, and getting as low as even below the 4% mark for one specific participant right there. Looking at 2025, again, we're getting below the 4% handle, even into this 2.5 below 3 handle. And the federal funds rate is just going to go lower. And we saw this in the Fed fund rate futures. Just yesterday, we were talking about the first cut coming in May. It's now moved to March. We're getting this rate cut in March apparently now, and then another rate cut in May, and then another rate cut in June, July, and then September. Crazy. And we're starting to see the signs of bull steepening. Have a look right here. This one has been really stubborn. The 2-year yield down 6% on the day, getting to 4.39. It's probably going to go below the 10-year. I think that's what we're seeing. I mean, the 10-year even fell, but this is actually what you want to see. You want to see the shorter end rates fall significantly more than the longer end rate so that we can get this yield curve uninverted. Look at TLT up 2.2% for the day, as well as bond futures and they were really bid up as yields fell quite significantly. I gave everybody this trade on Twitter. I was like, 4,700 will trade tomorrow if Powell isn't super hawkish. He wasn't even super hawkish. Dude was dovish. It was like pivot. If the Fed doesn't push back on how much financial conditions have eased, it says it all. Expect an end of year melt up. 4,800 can trade before the 3rd of January. Now 4,644. I think 4,800 is going to trade. I think 4,750 is going to trade pretty quickly. I think 4,800 is going to trade because there's so much dry powder still left in the tank. $6.1 trillion in money market funds. It was 5.7 2 weeks ago. We're now at the $6.1 trillion. This is a huge figure. It's going to all go into stocks. It's going to all go into bonds for this end of year Santa rally. I think it's going to continue. I think we're going to hit 4,800. That's my prediction for the next 2 to 3 weeks. But guys, we also had earnings, and we had Adobe report earnings. I mean, on paper looked really good, but I think the market was expecting more. I mean, just have a look at some of the data we saw here. You know, they increased revenue 12% year on year, 13% on RPO. Operating income was up 16% year over year, increase of 19% year over year in earnings per share. Absolutely crazy. Margins stayed pretty good. The stock was sold during the day when everything rallied, and after hours another 5%. So the market was definitely expecting more, and I actually was going to dive into Adobe and do a full fundamental analysis on the business until I opened Alpha Spread and saw that their revenues are declining over the next 3 years, as well as operating income, net income. Now I'm not sure if this is entirely accurate, but I'm not going to look at a company with declining revenues, significantly declining revenues over the next 3 years. But let's talk about Apple. Apple closed at an all-time high. It added $1 trillion in market value this year. And Apple is part of the Dow Jones. The Dow Jones also closed at an all-time high, 37,000. Just crazy, guys. Just crazy. Apple closed at 197. And I think the market wants to see $200. And Apple is one of only 4 stocks that have produced 50% of the Nasdaq's gain, which is actually very, very normal. In situations where the Nasdaq 100 contributed 10 to 25% plus in returns for the years, the number of stocks that have accounted for 50% of the return is very, very little. It turns out that concentration risk is actually a feature of strong rallies, not a bug. And this is why you guys should buy, hold, and avoid the noise. If you do that, buy, hold, buy strategic dips right here, your $1 would be $2,600 since 1900. And you can see here that real annualized returns in equities is 6.6%. With inflation about 2 to 3%, you could probably say that that number is about 9.5% total returns. And that's what you can expect in equities for the last 122 years. They've outperformed bonds, they've outperformed cash, and this is why you guys should always be invested. Buy strategic dips. And the general rule I follow is that when the S&P 500 falls more than 10% or about 10%, that is a level to buy at. And then every 10% subsequent. But can this trend continue for equities? Looking at 2024 specifically, S&P 500 earnings growth, it looks like it is. FactSet is predicting 11.8% in earnings growth. Like I told you guys yesterday, I think it's quite rosy. I'm thinking 8 to 9% is more realistic. And if you do plan for that, you do have a margin of safety with regards to this figure right here. Now, what normally precedes the materialization of this earnings is multiple expansion, and that's what we're seeing right now. Normally what we get is multiple expansion and then the earnings to follow, multiple expansion and then the earnings that follow, and this is what we're seeing in 2023. Multiple expansion, and what we should get is the earnings to follow, and it looks like according to FactSet we are going to get that. This is how I see 2024 playing out, right? I think what we're going to have is sort of like a flat to up mega cap 7, slightly higher 493. And if these 7 stocks move sideways and multiples on forward earnings for the 493 flat line at 15x, which is very reasonable, guys. Just on EPS growth of 8 to 9%, not 11%, on EPS growth of 8 to 9%, the index should trade 5,100. Now, yesterday we were talking about the sectors inside the S&P 500, pretty much saying that the S&P 500 is looking expensive, but sectors inside it, such as energy, were looking pretty cheap. Today we're going to do the same thing, but we're actually going to look at comm services, simply because it is predicted to be the second best growth sector in 2024 behind technology. And the reason why I like comm services even more than energy right now, the price to earnings growth. It's the best price to earnings growth in the S&P 500 sectors right now. And a 16 PE is not too expensive when you consider what you're actually getting inside this sector. Looking at the XLC, this is the Spiders Communication Services Fund. You You can see right here, very popular. I'm sure you guys know what this is. It just tracks the communication sector and the top stocks in there. It's got 22 holdings with a 17.21 PE. And look at this, guys, 3 to 5 year earnings per share growth, 18.12%. That's fantastic. And that's why the price to earnings growth rate is really undervalued. Generally, a PEG, anything under 1 is pretty much undervalued. Anything over 1 could be overvalued, and the XLC sits at 0.8, maybe 0.9 now after the rally in the last few days. Let's look at the actual stocks in the XLC, and you see you get some very high quality names. Meta, Alphabet, T-Mobile. If you guys don't know, these guys hit all-time highs today. Really good stock. Walt Disney could be a value play inside here, as well as Netflix, Comcast. A lot of these stocks have produced alpha, but a lot left to be desired with stuff like Verizon, Charter Communications, AT&T. So I'm not saying go out and just buy the XLC. I mean, it is cheap, and if you want to just set and forget, go ahead and buy this for 2024. If not, what you could do is look at names like Meta, look at names like Google, look at names like T-Mobile, look at names like Netflix. Pick out the best names that have had the best performance this year and then evaluate them individually. Maybe you buy Meta, Google, maybe you just buy Netflix. It really depends what you're looking at, guys. But just something I wanted to show you guys there, that the S&P 500 may look expensive across all metrics, but there is still value to be had in certain sectors. But if you don't want to buy a specific sector of the S&P 500 and want to buy the S&P 500 itself, what can you do? Personally, I would buy the equal weights. It's trading right now at about a 16 PE. I think it's 15.9, which is still pretty cheap compared to the PE of the actual S&P 500, which is trading right now at 19.3. So still great value in the S&P 500 equal weight, and I think it's going to outperform in 2024. And from a seasonal perspective, we're entering the most bullish period of December right here. We normally form a bottom anywhere between the 7th and the 14th of December before we go on an absolute run. We could have potentially already made this dip. We're absolutely rallying in December, up 3% month to date. And normally we do make a bottom sort of around this period right here. So in a couple of days is when we normally make the bottom. And that probably means we could see higher price action, maybe a tiny pullback, and then higher price action for the rest of December. But with the way stocks are rallying right now, it looks like we're probably going to go and try hit that 4750, 4800 handle. And if you actually have a look at the average day's performance in the S&P 500, this is 1950 to 2022. You can actually see right here that this week is actually a pretty negative week in December. It's sort of after the 18th when we do see much more positive seasonal flows, which could signify more upside in December into the new year. And looking at the gamma, guys, we saw the call gamma resistance move from this 4600 level all the way to 4700, and we're actually seeing a lot of built up gamma here at 4750 and 4800, and that's where I'm also seeing my targets. But a lot of this gamma is rolling over on options expiry this Friday, so we're going to see where the bulk of this gamma is going to be repositioned. But as it stands right now, all of this is literally just downside protection. All dips in a positive gamma environment will be met by bull demand. This is the year-to-date chart of the S&P 500. For those of you that don't know, go and watch my videos on the 25th and 26th of October. I said right here, buy with everything you have. And it's been a fantastic rally. I haven't said it's time to sell yet. We're going to keep holding. And I think we're going to go ahead and break 4750. I think we're probably going to go and break the 4800 level. This is the highest close since January 2022, early January 2022, where we made these highs coming off that extremely strong COVID rally that lasted the better part of 18 months. And I do think the market wants to go and hit these new all-time highs. And a lot of you guys will be looking at this and thinking there's not much more left in the tank. But what you guys have to understand is that new all-time highs is actually one of the most bullish things you could actually have in a market. And looking at today's candle, extremely strong. We opened, bears pushed us down a little bit, and then we absolutely just rallied to the day's highs. We did make a little bit of a wick, and there was a tiny bit of profit taking at the end of the day, but all in all, an extremely bullish candle. That's a bullish candle. That's a bullish candle. That's a bullish candle. Minimal wicks on the top and bottom, closing at the day's highs. Any retrace we get into these levels right here, into just below 4700, is going to be met by bull demand. What do I expect for the rest of the week? Well, we just had Vixpiration. We are coming into OPEX. Market makers are going to sort of have to roll everything over. So we can just expect a little bit of chop before we go into next week, which is seasonally bullish to go and make higher price action. I do see 4750 next week. It could come this week with the way we're rallying, but definitely next week I do see 47.50. This is the IWM. It keeps putting up these insanely strong candles right here. And again, today it was up like 3% in today's trade. And I gave you guys this trade at about this level right here, about 168, 170. And I said we're probably going to go and touch 200. And I think that's what we're going to go do. I think small caps are going to go and touch 200. And if we do get the soft landing, no landing, and rates do come down, small caps are going to absolutely rally. And I think they're going to outperform in 2024. But even more specifically, I think mid caps are going to outperform in 2024. Looking at TLT, and this is another trade I gave you guys on the 1st of November. Right in here, we're up about, 12% since then. And this is the line I was looking at, 97.34. We're very, very close. We're about half a percentage point away from the line that I think once we get above here, we're going to see a lot more bullish price action. But, we get above here and sort of just base before we go and rally up into the rest of 2024. I'm extremely bullish on bonds. And by the way, in total return, the TLT is positive year to date. Now, looking at the RSP, and on a year to date basis, right at the October low, the RSP was negative 6%. We're now close to 9.42%. And this is just in price return. I believe the RSP pays a 2% dividend, and that the next dividend is in January. Really, really good. Holders of this stock have been blessed since this low if they bought it, but they've also been blessed if they bought it at the start of the year. 9%, that's really, really good. You're looking at like a 7%, 7.5% real return, and with your dividends probably closer to 8 or 9. Fantastic price action in the RSP. I like what I'm seeing. While I'm not a buyer of the RSP, I do think it's going to outperform in 2024. And for those of you that are worried about buying the high, thinking you're buying an all-time high, let me ease your mind right here. This is the S&P 500 after a bear market and coming up 20% off the bear market lows. Where we are right now, right, we're about 22% in the S&P 500. In every single instance except one, it was always positive returns. 12 months later, after 20% off the bear market lows, an increase in 20%, we normally see an average return of about 18.9% and positive 91% of the time, 22. Now let's talk about dark pools. Oh, very interesting stuff right here. If you guys do trade dark pools, something I wanted to show you, the Carver Group, a ton of dark pool activity came in right here, and it's been up 27% ever since. So, if you guys want to maybe go scan for dark pool activity, look for buying like this, huge trades. You see this, it often is a sign, especially at lows, that price could be going higher. Now, looking at, I gave you guys this yesterday, the iGov, pretty much the TLT, it says international treasuries, but it's like 98% US treasuries, 16, 17 year duration. The biggest trade since inception came, and we know what happened with the TLT. We know what happened with bonds. Absolutely rallied. It went up. And again, this is what you want to see in dark pools. When you see stuff like this, at lows, this is multi-year lows. That's probably a very good sign that we're probably going to go higher. And the thing with, one thing I want to note, bonds guys, is that the big guys don't really trade these tickers. These are more investment vehicles. They normally buy and hold, or short and hold for the longer term, and then buy and hold, looking for the longer term. And I think 2024, we should go ahead and hit this, this 50 handle, maybe just below the 50 handle right here in iGov. Now, guys, looking at data ahead for the week, we had the big one, the FOMC and PPI. Very, very dovish and bullish in those data points. We do have initial jobless claims tomorrow, as well as retail sales. And then that's really it. We do have a couple of PMIs Friday, but yeah, just beware of retail sales and jobless claims tomorrow. But if you've made it up until here, guys, please go ahead, subscribe to me, leave a comment, like this video,